Hey, everybody. Good afternoon. Scott Franklin here, First Look Mortgage. I want to welcome you to the First Time Homebuyer webinar. You are absolutely in the right place at the right time to get all of the information that you need in order to navigate the home buying process. And hopefully when we're wrapped up here, you're going to be put at ease and be ready to jump into the process and get this ball rolling. So I strongly suggest that you have a notepad and a pen handy because you are going to want to reference this information at a later date. And I'm pretty sure that we're also going to be sending a PDF copy to every participant on the webinar. But again, you just want to make sure you have your handwritten notes to highlight stuff you can reference pretty quickly. You're also going to be receiving, if you haven't already, a free e-booklet download for a first-time homebuyer's guide, which is chock full of a ton of useful information to either familiarize yourself with the process or refamiliarize yourself if you haven't done this in a while. A lot of things have changed. So there's a ton of valuable information. Make sure you jot your questions down. I'll show you how to get those answered in just a little bit. So here we go. We're going to go on and jump right in now. So please forgive me. I'm not very tech savvy, so I might have to struggle with some of these slides a little bit, but we're going to try to get this rolling here. Okay. So First Look Mortgage, who are we? Who is First Look Mortgage? We are actually one of the highest rated mortgage brokers in the state of Kentucky, the state of Maryland, and the state of Florida, which is all of the states we're licensed in. We're out of Louisville, Kentucky, but we're one of the highest rated companies through LendingTree, through the Better Business Bureau, and through Google. So please make sure you check us out. We are a family-run, veteran-owned. I spent 6 years in the United States Navy, the USS Saratoga, CV-65 as a hospital corpsman. So we are a veteran-owned mortgage brokerage, again, licensed in the state of Kentucky, Florida, and Maryland. And we have the backing of probably 10 of the nation's largest wholesale lenders, largest wholesale mortgage lenders that you've never heard of. But what that means to you is that we don't get beat by rates or costs with anybody. A little plug for us here, but I can do that because it's my webinar. But we absolutely guarantee not to be beaten with rates or costs by any of our competitors. We have very little overhead. We're a small operation, and we take a much smaller compensation level than 99% of our competitors, and we can pass those savings on to you with lower rates and lower cost. And we're so sure of that, and we're going to get into some of this later, so I'm just doing a little plug here, but we're so sure of that once you get the ball rolling, if you find someone that beats us with rates or cost or a combination of both, we're going to pay your appraisal fee for the other lender that you choose to do business with. So again, more on that later, but right here, let me see if I can look over here. Right here, this is Lynn Marie. This is me, Scott. Lynn and I actually met in 2004 in Fort Myers, Florida. She was a realtor and I was flipping properties. I had just moved down from Louisville down to Fort Myers, left a position at U.S. Bank as a financial advisor, started flipping houses, and we've been together ever since. So from 2004 till 2008, we were buying properties. 2008, we got into the mortgage business together, have stuck it out since then. And I believe in February, March of 2017, we opened our own mortgage brokerage shop and have been rolling ever since. So let me take a look here. And I can truly say this too. I mean, I can very, very candidly and wholeheartedly say this as well. If Lynn or myself cannot get your loan closed, I don't know who can. I mean, there's a ton of programs out there from 500 credit to 900 credit. We've got a program for every single person. And if you want this to go as smooth as humanly possible, I promise you, Lynn's your girl or I'm your guy to get this squared away. First Look Mortgage should be your first call. Okay, so let's move on here. Let's get on going down the road. This is actually our office. I want to show you this because we've got a real office. We're not just cowboy or internet cowboys trying to drum up business. We are actually a real operation with we just put 2 new signs up in the front and the back of our building. This is our front door when you walk in. The front door opens up to just a little greeting area, a little sitting area, nothing major, moves on into our conference room. And if you can see, let me move this out of the way a little bit. Okay, and then this is actually my desk right here next to the conference table. We do probably 10 to 15 closings a month at this particular table. And you can see I get the upfront room, and then Lynn got this zen area with the windows and the curtains and all the nice stuff back there, little relaxing area, candles. My gosh, she's got incense. I mean, it feels like you walked into a massage parlor back in her office back there. It's very comfortable. So lesson learned to all of you guys. If you're going to open a business with your partner, and there is an office choice and one is a secluded area with a ton of windows and a ton of light, they're going to choose that if you give them the first choice. So just a little bit of heads up on you there. Okay. All right, this is our Better Business Bureau page. I'm showing you this to let you know that we are an accredited business. As of right now, this recording, we are an A-rated company, and we're not A. The only reason we're not A+ is because of time in business or time of accreditation with the Better Business Bureau. They require a minimum of 3 years in business and multiple 5-star reviews with 0 customer complaints in order to receive that A+ rating. But we're going to be there very soon. We're a few months away from that. And again, we're very proud of this. So please check us out with the Better Business Bureau and all the states we're licensed in. We're very proud of what we've done, the reviews we have. We're one of the highest rated companies in all of the states that we're licensed to do business. So make sure you check us out, do some diligence. We're very proud of that. Now this slide has no bearing on anything. This is just, I wanted to show you, I've got a really cool Jeep that has my company logo on it that I'm just really proud of. So it's really cool. And again, yes, if you get right down in here, that is my phone number. Please feel free to jot that down, text me, give me a call, smoke signal me, whatever you may need. We would love to get your questions answered one-on-one, individually, make sure everything is squared away for you before you start this process. So please do not hesitate to reach out. That is my actual phone number. And again, we'd love to make sure that all of your questions are answered. Oh, you don't get to see that one very well, do you? That's the main one. All right. Okay. All right, what's the difference between a mortgage broker and a bank or a direct lender? And that's a fantastic question that we get all of the time when we're competing for business on some folks walking into a local bank. So a bank or a direct lender is actually an institution or someone that lends their own money, sets their own rules to protect the assets of the institution, and they typically have one set of loan product or products in each different loan category, and they're limited by the restrictions that they placed upon themselves on top of the guidelines that are already affiliated with that particular program. For instance, a USDA or a rural housing loan is, this is driving me crazy down here. Let me get out of the recording here for a second, see if I can get that out. Okay, so for instance, a USDA or a rural housing loan has a minimum credit floor of 550 to do a loan with them. But if you walk into let's say a Chase or a U.S. Bank, Fifth Third, or somewhere that offers the USDA rural housing loan as well. Not that I'm not disparaging them one bit. They do a great job at what they do. But what they'll do is they will add a credit restriction, a credit score restriction higher than the one that's already placed by USDA. So where USDA says we can go down to 550, one of the larger retail banks may set their guideline at 620 or 640, and they do that. They put what's called an overlay or an overlaying guideline on top of that in order to protect themselves and have a smaller risk of default on those loans. Now, a mortgage broker, which is what we are, we represent multiple wholesale lenders and typically have far fewer restrictions on the guidelines on each available loan product, and which means we can typically find lenders that go strictly by the guidelines that are enforced by the particular agencies that are guaranteeing the loans. For instance, the same VA, like where I could go to 550 on a USDA loan, the banks might be at 620 or 640. I can go down to 500 on a VA loan for veterans, and a lot of times they're going to limit them at 600 or 620 as well. They might also limit their debt versus income, DTI. We're going to cover that shortly. They may limit those ratios where we can go outside of the box a little bit to what the VA says we can do. So we don't have to put those other restrictions or handcuffs on the loan products that we offer, and we've got something for everyone. So again, if you've got 500 credit, if you've got 800 credit, we've got a perfect lender for the 800 credit folks, and we've got a perfect lender for the ones that are a little less than perfect on their credit score. So we've got programs for everyone, and I get this all the time. Which one is better? There's really not an answer to that. That's up to you. I mean, I personally think we're better because we have more programs and less restrictions. We can close a lot quicker, and it's a lot more of a personalized touch than if you were to walk into the big box, have 60, 90 days to close. They'll pass you off to 3 or 4 different people, and nobody really holds your hand through the entire process, where we're going to do that. So it's up to you. If you want to walk in the bank every single month and talk to Mary and feel comfortable about writing your check, then yes, that's probably going to be the best thing for you. Hey, there I am again. All right. That's probably going to be the best thing for you. But if you're looking for ease of use, someone that's going to hold your hand from the beginning till the end, someone that's going to make this as smooth as humanly possible for you, and offer pretty much every available loan product without any overlaying guideline restrictions, then a mortgage broker is going to be the way. It's going to be the way for you to go. Okay, what are we going to be covering in this webinar? Let me look at oh, it's right there on the slide. I don't need to worry about it. So pretty much from A to Z, we're going to cover the entire process, starting with pre-qualification. We're going to go over credit requirements. We're going to go over income requirements, and which is called your debt versus your income, or DTI, things you're going to get used to hearing. We're going to go over the different loan programs that are available for you, whether it's FHA, VA, USDA, conventional, et cetera, et cetera, et cetera. Some of these terms are going to be foreign to you at this point, but we're going to make sure we cover each of those to let you know what's available for you. The down payment requirements for each loan. Is there down payment assistance available for me? The acceptable property types. Payment breakdown, what is in your payment, principal, interest, taxes, and insurance, otherwise known as PITI. We're going to cover that as well. We're going to go over what are the closing costs, how much to expect, who pays them, how to get the seller to pay them, what you should expect based on the loan amount you're having. Do you need a realtor? Selecting a realtor, we're going to cover that in detail. The do's and the don'ts during the process. This is very important, so make sure you pay close attention to this as well. How long to expect the process to take from start to finish. We'll go over from A to B on what to expect there, what to expect from a closing, and then after closing, now what? What do you do after the closing? Well, at that point, you just move in your house, really, and you get everything turned on. But we're going to cover some of those bases as well. And then those of you that are licensed, not licensed, I'm sorry, those of you that are in the states of Kentucky, Florida, and Maryland that decide to do a pre-qualification with us and go down the path and hopefully allow us the opportunity to earn your business and get you into a new home and take care of your loan for you. We have an unbelievably special offer that we put together for you to put money actually back in your pockets at closing. If you're outside of these states, this is still a complimentary free webinar for you guys to take full advantage of. You're still going to get the e-booklet download at the end if you haven't gotten it already. So it's a bunch of valuable information for you anyway. So please make sure you stick around as well, and we'll do what we can to get your questions answered for you guys as well. So let's just go in and dive right in and get this thing covered. So now that we know what we're going to be taking care of. Okay, what's my very first step in this process? What is the very first thing you need to do? Take a breath, relax. We got you covered on this. We've been doing this for a long time. We're going to talk to each of you individually that decides to do this, go down this road with us. We're going to give you an outline of exactly where you are, where you need to be in order to get where you want to go. So just relax, take a deep breath, and let's start with the pre-qualification process and let you know exactly what goes on with that. And we'll get this thing moving for you. So pre-qualifying is your very first step in the process. What we need to look at is for each person that's going to be on the loan, we take a look at the credit profile. And this gives us, or this guides us towards what available programs are available for you. For instance, what we take a look at, if there's one person on the loan, we pull a Tri-Merge credit report, which is TransUnion, Equifax, and Experian. And then we take that middle credit score, and that's what we use for risk evaluation. If there are multiple people on the loan, then we use the lowest middle credit score for that risk evaluation. So if you've got someone, let's say a husband and a wife are applying together as a joint loan application. The wife has 720 credit, but the husband has 620 credit. Well, we've got to use the 620 credit for the 620 credit for risk evaluation. And a lot of times that makes it a little less attractive than what you were hoping for. We don't get to use the highest credit. We have to use the lowest credit. In some instances, or in every instance, we can show you how to get that up with what's called a what-if simulator that we have within our system to let you know, hey, you've got a 40-point increase possibility here if you just maybe pay a couple of these balances down to this, or pay this off, or restructure this account, or do that. But we've got a simulator to help you get there, give you an idea of where you need to be, assuming you've got the time allotted and the money to do what you need to do. So the first thing we take a look at is the credit profile for each person on the loan, which gears us and guides us towards the programs that are available to you, because every loan program has a different credit criteria. Every loan program has a different income criteria for debt versus income ratios. So that's the next step, is we're going to need to see income documents for each loan applicant as well, such as your pay stubs, your W-2s, tax returns, bank statements. We need to verify all sources of your income, your wages, your salary, your bonuses, your overtime, commissions, whether you're self-employed, 1099 as a contractor. Everything works a little bit differently with every program. So we need to make sure that we fully understand where your income is derived, exactly how much it is, and match that up against your debts on your credit report. And then there's a formula we use. We take the debts, we take your total income, and there is a portion of that income that we can use in order to figure out how much we can use of your money to purchase your home with your property taxes and your home insurance included, along with all of your other debt showing on credit. And that's what's called your DTI, or debt to income ratio. Every program has a different requirement what they will allow for debt versus income ratios. Now, some are very tight, some are more lenient. So it really just depends on where that falls along with your credit score, so we can figure out exactly, where to navigate that process, or where to navigate those waters to get you into the right loan program. We also need to see any available assets that you may have: 401k accounts, retirement accounts, bank statements with all of your pages, stock accounts, brokerage accounts, anything that you have where money's sitting, whether we need the money or not to close or for down payment or whatever. The stronger, the more assets that we produce, the more assets we provide, the stronger the loan will look to the underwriter. So it just strengthens the loan in the eyes of the underwriter. Again, whether we need to use the assets or not, it really puts a nice padding and buffer on that application for us, so the underwriters can say, okay, they've saved really well. They've got $5,000 in an IRA account. The guy's got $20,000. He's been in his job 5 years. He's got $20,000 in his retirement account. I know we don't need it, but they're savers. They're looking good. It makes it nice and warm and fuzzy in order to get the underwriter to, we want that green stamp of approval at the end. So once that's all taken care of, we use that formula I told you to calculate your debt versus your income. That's known as your DTI, which is one of the largest and key factors in deciding how much you're able to afford each and every month for that mortgage account. So we're not going to get heavy into DTI right now, again, because each program is just a little bit different, has a different set of guidelines, and we'd be here literally all day going over that. So we're going to cover this individually, one-on-one, when we talk to you guys, to let you know where you stand, because everyone is a little bit different on DTI. Okay, next we're going to be covering what the underwriters look at to determine the strength of the loan, and it's called the 4 C's. You may have heard this if you've looked at anything online in regards to, what the underwriters are going to look for. It's called the 4 C's. Now, what that stands for is credit, capital, capacity, and collateral. Credit, again, we use the lowest middle credit score for each borrower on the loan to determine that, what that risk factor is going to dig into. So the better your credit, the stronger your loan. Capital is the amount of money you have saved for all of your costs. This is your money. This is the amount of money you have in your bank accounts, your 401k, your retirement accounts, et cetera, et cetera, et cetera. The more money you have access to, the stronger the loan. Capacity, this is your ability to repay the loan or your stable income. So if you've got a very consistent income over the past couple of years, you haven't jumped jobs 15 different times. Now that's okay if you've jumped jobs around to do things better. That's you're not penalized for that. But one of the things they look at is how consistent is your overtime, how consistent are your commissions, how consistent are your bonuses, if we're using those to qualify for income. So if you've been in a job 6 months and you depend 50% of your income is derived from commissions, and this is your first commission job, well, that's probably not going to fly, because they certainly, when you're on commission or income that's not stable with a salary or on an hourly basis, they want a 2-year history on a lot of that type of income. There's programs we have to get around that as well, but you pay a little more for it. So capacity with your stable income, the more stable and consistent your income, the stronger your loan. You've seen a pattern here. So the collateral is next on the, where we at? Collateral. So the collateral is the value of the property that you're buying. The stronger the collateral, the better the property is, the better the loan looks in the eyes of the underwriter. So these are the 4 C's. You may have heard these before, you may not have, but when you look it up, this is what really lets them dive into the strength of the loan on what, on top of all the other guidelines they have to look at as well. So these are the four main factors they look at: is your credit, the amount of money you have, your job, your income, and the property that we're loaning money on. So after those are all, once everything falls into play there, we pretty much have an easy loan to do at that point. All right, let's talk about some of the credit requirements for a while, and let you know what you need to, in order to get things squared away. So the credit scores that we typically see range from 500 to 840. And, the better your score, the better that your rate's going to be, and the better that your costs are going to be, because your rate on the loan is directly related to your credit score. So if you've got 500 credit, you're going to have a much higher rate than someone that has 750 credit. That doesn't mean we can't get your loan taken care of for you, but just be prepared. If we don't have any room to play or improve your credit over the course of the loan process, 30, 60 days, whatever program we're going into, be prepared. You pay a little more when you have a little less credit, and you get much better ratings if you've got a higher credit rating. You probably know that with car loans or credit cards as well. It's the nature of the beast in it. So with the lower credit scores, there's going to be more scrutiny on your loan file, but we close these loans every single month. And just be prepared for some extra documentation, maybe a few extra steps in the process. They may have some letters of explanation on derogatory credit that we need to go over, but just understand that we can still get those taken care of. It just may be a little bit extra for you as far as legwork goes. Okay, and most banks and most direct lenders, they're going to have a 620 credit requirement or better for each borrower on the loan. But we, as a mortgage broker with access to multiple lenders that do not put those overlaying guidelines on top of it, we have programs that go down to 500 for pretty much every loan program that we do. So just know that even if you've had some history in the past that was bad, we can get things squared away for you and moving on the right track again. So each loan program has a different credit score requirement, and each applicant's not going to qualify for every program. So that's why it's imperative that we start the pre-qualification process as quickly as possible, especially if you're going to go out looking for homes. There's no realtor in the world that's going to want to take you out if they know you can't buy a home. And they're not paid by the hour. We're not paid by the hour, and we want to make sure we know up front what we're dealing with before we get anything going on. So every realtor that you're going to talk to is going to absolutely want to make sure that you have a solid pre-approval in place where someone has evaluated your income, your assets, your credit profile, and no money you have to put down, if any. So credit reports are good for 120 days. So what that gives us is approximately 90 days from pulling your credit to have your loan process started, because we need about 30 days, typically less, to close a loan, but I always say 30, just in case the things come up with the appraisal or inspection or things that we need to address that might delay that process. So if we get you squared away, if we pre-qualify you today, within 90 days, if you've gotten a contract or have a contract in place, we're typically pretty good. There's no need to repull your credit. So 120 days is the lifespan of a credit report. And just so you know as well, so I don't forget, I didn't write this down in my notes anywhere, but I'm thinking about it right now, is what we see on our Tri-Merge credit report is a lending model. It's a home lending model. So I see the same thing that Chase, US Bank, Fifth Third, Republic Bank, any of the larger banks, we all pull from the same credit model. And it's not going to be the same thing you see on Credit Karma, Equifax.com, Experian.com, because there's things we take into consideration that's not scored on those, and there's things that's scored on those that we don't care about. For instance, medical collections. We don't care about medical collections. Those, I mean, they're going to bring your score down, but we can get around them. We don't even have to write letters on medical collections because you didn't go out and try to run up medical bills as if you let a credit card go bad. These are things that are unfair practices that come into play as far as the way the collections are handled for medical bills, and that's been kind of wiped away. So medical collections, they're going to drag your score down a little bit across the board, but we don't care about them, and they're not going to hinder you from getting a home loan. So if let's say you've got a 550 credit score, and it's all because of medical collections, well, that's going to be an easier loan to get through than someone that has a 550 score and a repossession of a car last year and a foreclosure 2 years ago and someone that switched jobs 10 times. And it's just, there are things that there are instances where your credit score takes a huge dive at no fault of your own, and it's pretty unfair, especially with the way that's practiced on the medical collection side of it. So again, if we need to address issues on your credit report, the pre-qualification stage is the time to work on these. So again, we have that what if simulator I mentioned earlier that we can tell you what we need to do to get that score up, or again, if it's just medical collections and there's nothing we can do about it, that's okay too. We can just write it, we can put a little explanation together on that, send that up with a loan application. Typically that's not going to ever stop you whatsoever in getting a loan. Okay, what if I've had bankruptcy or foreclosure or short sales or repossession? So typically what we see are Chapter 7 and Chapter 13 bankruptcies. The Chapter 7 is the one where you wipe everything out and kind of start fresh. The Chapter 13 is where you pay it back. But typically, every program has their own set of guidelines on when you are able to reapply for a home loan and get qualified. Typically, it's 2 years after a Chapter 7 discharge. You can buy a new home, but some programs require 3 or 4. So everyone's just a little bit different. We have a cheat sheet we look at, and we'll let you know if you've had that. So what they're going to look is how long ago was your discharge, not when you filed it, when it was actually discharged. And typically on your credit report, it's going to show a public record, bankruptcy status, discharge, or pending. If it's not discharged, there's nothing we can do at that point with with conventional lenders, but we have some other lenders that will look at that as well. You may just have to put a little bit more money down, take a higher rate, something like that. So a Chapter 13, which is the one where you're in repayment, is absolutely acceptable as well. So and the timeline for Chapter 13 is 1 year after you're in repayment. It doesn't have to be discharged, but as long as you have a satisfactory repayment history within the court, and the court trustee signs off on you being able to get a new loan because you've done everything right, then you can qualify for a new home loan as well on the Chapter 13 bankruptcy. So that's pretty sweet. I mean, and it also looks, it's also, one's not better than the other in the eyes of the credit score, the loan, but if you're paying something back, in my eyes, and I've got to believe that holds water in the eyes of the underwriters as well, you made some mistakes, you're working out, you're paying them back, and you're doing everything you're supposed to do. The most important thing I can tell you, for those of you that have had a bankruptcy, is if you've had a bankruptcy discharge, let's say 2019 right now, April 2019, let's say March of 2017, you had a discharge, the Chapter 7 discharge. What they're going to look at more importantly or more closely than anything is what you've done since that bankruptcy discharge. Have you reestablished credit? Have you paid everyone on time, or have you gotten yourself in hot water again? I can tell you this, if you've gotten yourself in hot water again, you're going to need a full 12-month history after you've gotten yourself in hot water again in order to even be able to think about doing anything on a loan again, unless you want to pay 3 or 4 points higher, a bunch of money up front, and some other very high cost options for you that I hate to even recommend to folks unless you just absolutely have to get into a home. But they're going to look. The main thing is what you've done since that bankruptcy. So if you've messed up after the bankruptcy, life happens. We understand. But just be prepared that it's going to be, you've got to get back on track for at least 12 months after that flub up to be back in good graces for conventional style financing. Again, each program has different rules on this, and if you are in this situation, let us know, give us a call, shoot us an email, and we'll get you squared away to find the answers that we need in order to get you moving down that right path as well. All right, let's talk about debt versus income a little bit, DTI. We brushed on this very briefly earlier, but let's go over some of that. Okay, each person is going to be different on the debt versus income, and some debts can be wiped away or disregarded if there are only a few months left to pay. Some student loan debt is not counted on certain programs, where it's absolutely counted to the full hilt on other programs. And again, I'm not going to go into great detail on this, but I'll give you a couple of examples. On certain loan programs, if you've got an income repayment plan on your student loans, which is we see 10 times a week, there are some loan programs that will not allow us to use that payment. They'll make us use a full 1% of the balance you owe, whether or not that's what you pay, because the income repayment can change every single year. You make more money, you pay more money. So that can be a fluctuating payment. There are programs that will not allow that payment that you're actually making. They'll make us take the highest payment that it could possibly be in order to evaluate the risk of that loan. There are other programs that will allow us to take the payment that's actually showing on the credit report. Again, it just depends on what programs you're going to qualify for. Same thing with car payments. If you've got 3 months left, 6 months left on a car payment on your credit report, and it's an actual auto loan, we can typically wipe that debt away and not have to count that against your debt versus the income that you have. However, if you have a lease as opposed to a standard car loan, we cannot wipe that away, because in the eyes of history, you go out and get another lease. So that's going to be there as well too. So again, each thing's a little bit different, and there's way too many variables to spend a ton of time on this, because each situation is so different. So please reach out to us directly and let us know what your situation is. We'll walk you through to let you know exactly where you stand with your credit report, your debt versus your income. So you have to meet a certain formula with your active debt showing on credit against your pre-taxed gross income. This is typically, let me move this out of the way here. Where we at? Nobody cares about my mug. This is typically maxed out at 45% of your gross income that we can use all debt, so that we can count all debts plus your new housing payment. But it typically can go, but it can go higher depending on the loan program and your credit score. So we go back to those 4 C's. The stronger your credit, the stronger the loan. Sometimes we can go outside of the norms of what the standard regulations might be. So let's do an example here. If you have a salary of, let's say, $40,000 per year, your gross income before taxes is $3,333. Now, if we take 45% of that $3,333, that gives us $1,499 we have to play with that has to cover all of your debts showing on credit, car payments, student loans, credit cards, and your new housing payment to include property taxes and insurance, or PITI, which we're going to cover in a little bit. So again, $1,499 in most cases would be the maximum debt ratio, which would include the new housing payment with property taxes and insurance included. So let's say, oh, sorry about that. So if you have $450 of minimum required payments showing on credit, car payment, credit card, student loans, we would deduct $450 from the $1,499, leaving your total housing payment at a maximum of $1,049. Now, I've been doing this a long time. I can back into that and tell you, you're going to be looking at about $135,000, $140,000 house, all in with property taxes and insurance, just based on one of the very low down payment programs. So the stronger your income, the stronger your credit, we can have a little fluctuation and have a little more room on those debt, on that debt ceiling, in order to maybe get you in more of a property, more of a payment range to get you a nicer home. So we talk about the PITI, the complete monthly payment breakdown, but let's go over exactly what that's going to entail, and so you can see it firsthand. So PITI is the principal plus the interest plus the property taxes plus the home insurance, and PMI, private mortgage insurance if it's required. Now, PMI is typically, and there's ways around everything, and we'll cover that shortly, but PMI it's a fee you pay to the bank every single month if you typically don't have 20% down on most loan programs, and you're paying an insurance policy for the bank. If you default, they get their money back. So you're paying an insurance policy. Listen to me very carefully. You're paying an insurance policy on the bank's behalf in case you default. That's like you paying it. That's like you paying life insurance, and then it's going to your employer when you die. It makes no sense to me. So if we can get you out of PMI, and with strong credit or maybe a little bit more money down, we can do that. If you have to have it, you have to have it to get in the house. But we try to steer folks away from PMI if at all humanly possible, unless it just makes sense for the time frame you're going to be in the house and some different situations. But we're going to cover we'll cover that on an individual basis, because there's so many different, again, variables on PMI. Different loan programs have different rates. Some programs don't have it at all. Some have very little, where it's minimal at best, and it's not even going to take a cup of coffee off your plate every single week. So we can go over that one-on-one individually once it's time to really dig in for you guys. So let's use an example here on a $100,000 purchase. This is an FHA loan, and we're going to cover the loan type shortly. So on a $100,000 purchase at a 4.5% interest rate on a 30-year fixed loan with 3.5% down. That's 3.5% as your down payment. We're going to cover the down payment requirements shortly with some of when we go to the loan programs. This gives us a base loan amount of $96,500. So we're putting 3.5% down on $100,000. That's $3,500. Takes us to a loan of $96,500. Now, with an FHA loan, there's an upfront fee that you pay. It's going to make this actually a little bit higher. We'll cover some of that shortly, but just for the sake of argument, just to keep the numbers nice and smooth at this point, we're going to use this example. So the total estimated payment on a $100,000 purchase with a loan of $96,500 at 4.5% is $720. Now, how did I get to that $720? Well, the principal breakdown on 4.5% is $128. So look, that's what every single month, only $128 is going to principal, $365 is going to interest. Now, I say nice thing, but the very slow realization is every month this is going to flip-flop by about $1 to $2, $1.50 to $2. The more, typically when you get into that 10th, 11th, 12th year is when it starts to be more principal you're paying than interest. But for the first third of the loan, it's front-loaded with interest, to where most of that interest is going to be with the bank. let me get out of here for a minute. It is going to the bank. So the estimated property tax is typically, this is a rule of thumb. It's not an exact science at this. Every county in every state is a little bit different, but estimated property tax is about 1% of the value of the home. So in this case, value of $100,000, we're going to be about $83. So $83 per month on our taxes. Okay. Estimated home insurance is going to run you about $75 per month. And then private mortgage insurance, or PMI, is going to run $68 with FHA on this. So it's pretty standard when not putting 20% down. If you've got really good credit, we do have the programs to get around this, but this is the standard. So this is on $100,000 with 3.5% down. I'm going to show you a couple of more examples with 5% down and 20% down to show you what those payments could break down for. So this is a $200,000 home. I've got one example with 5% down, or $10,000. I've got another example with 20% down, or $40,000. Loan amounts vary quite a bit because of the down payment you're putting. Same interest rate. The principal and interest on the 5% down is $962 per month. The principal and interest on 20% down is $810 a month. So you're looking at $152 difference right there. And then there's going to be PMI on the 5% down, and then there's no PMI on the 20% down. This is a standard, just a standard look, because I can actually get you out of PMI with good credit on 5% down. You might have a slightly higher interest rate. But in this example, the total payment with 5% down is $1,043. With 20% down, it's $810. So it's a $232 a month and 75-cent difference by putting more money down and avoiding that PMI. So it makes a huge difference if you have the money to put down, and every single loan program is going to be just a little bit different. Man, I had to take a little pause there. I'm in Louisville, Kentucky. I'm not sure how many of you guys are actually in Kentucky that are watching this, but this is just the height of allergy season, and my eyes are absolutely, it looks like I just came from a funeral from a loved one. Absolutely just crazy, crazy, crazy. I cannot put enough Visine in. I can't take enough Zyrtec, and I'm just in that phase right now where nothing other than sleep and a cold rag really helps. But enough about me and my problems. Let's dig back in. So the example here just gives you the basic understanding of, one of the lower down payments with the FHA loan on the previous slide, and then what 5% down, 20% down looks like without that PMI or private mortgage insurance, just to kind of give you an idea of where things are. So let's go over some of the loan programs, what the down payment requirements are, and what's going to be right for you based on your needs, your income, your ability to come up with some money down, or what we have to do. So the first one, probably, there's 4 different loan programs here that I put. There are a ton more, but these are the 4 main ones that we see day in, day out. Now, I'm not going to go over jumbo self-employed loans, NINA loans, no FICO loans. There's 15 other different loan programs that we can use, but these are going to be the base 4 that you hear people talking about. These are the bread and butter of pretty much every mortgage broker. First is an FHA. This is the Federal Housing Authority, or Federal Housing Administration. I never really know which one that is. This is a government-insured loan, and it has a required minimum down payment of 3.5% of the purchase price. So again, using the $100,000 example, you've got to come up with $3,500. If you're buying a $200,000 home, you're going to come up with $7,000, and so on and so on. And there is, each county in every state has a different loan maximum that FHA will allow. In certain counties, it's I think in Louisville it's 314,000 some change. I believe, I haven't checked that in a week or two. Sometimes they change a couple times a year, at least once a year. In some counties, in higher cost areas, Baltimore, Maryland, parts of Virginia, California, Texas, or parts of Florida, that goes up drastically. It goes up a couple $100,000 more because the property values are quite a bit higher, so they go up a little bit more. So FHA is going to have PMI or that private mortgage insurance added to each loan. For either, if you put 3.5% down, it's going to be for the life of your loan, no matter how much you pay off of it. If you stay in that loan, you're going to be paying PMI the entire time you have that loan, unless you refinance it and get out of it. If you put 5% or more down, it's on there for 11 years. So that's why sometimes a little bit more money down puts you in a better situation. But if you're going to put more money down, that might take us to a different program where you don't have to worry about the PMI anyway, depending on your credit scores. FHA also has and I put funding fee here, but that's just kind of my terminology. It's actually called UFMIP, or upfront mortgage insurance premium. So that's basically you're paying your first full year of PMI to FHA, and then you're gonna pay it monthly to make sure it's paid at the end of the year when it comes due again. And this is 1.75% that's added to your loan. Now, this gets financed right on top of the loan. Now, if you've got closing costs paid by the seller and they're substantial, we can have the UFMIP 1.75% paid in full up front, where you don't have to worry about it. Or if you want to pay it up front in full, where you don't have that added on there, that could be an extra, $2,000, $4,000, $6,000 on your loan. You can pay that as well, but it has to be paid in full. It can't be partial. It can't say, okay, I'll pay half and I'll finance the other half. If it's on there, it's on there. If it's not, it's not, because it's paid in full by either seller concessions, which we'll cover shortly, or by you paying it out of your closing costs, again, which we'll cover shortly. But they do have what I just say a funding fee, just it stays in my head that way. 1.75% gets added right on top of the FHA loan. The VA loan, the Veterans Administration loan. This is, if you're a vet, if you were discharged honorably, even other than honorably, just not dishonorably. As long as you do not have a dishonorable discharge, I've never seen a veteran not be eligible for their certificate of eligibility. And this is absolutely, hands down, the best loan in the country. And I'm a veteran myself, and it just ends up being where we do a ton of these loans. We market to a lot of veterans as well, but probably I would say 60% of our business is VA loans. We love doing them. The underwriting's super, super easy. They're a lot more lenient on the debt versus the income. There is a funding fee, but there's no mortgage insurance, and they will allow zero down payment up to 100% of the purchase price of the property you're buying. You're buying a $400,000 property, they're going to finance $400,000 for you. There's going to be no PMI, and then we just got to worry about getting creative on your closing costs. So their funding fee, it varies depending on whether you have used your VA benefit previously, whether you have a service-related disability from the VA, or whether it's your first time use. And those numbers are going to vary. Too many variables at this point to really cover them, but there is going to be what's called a funding fee. If you've never used your VA benefit before, it's lower. If you have used it before, it's a little bit higher. If you're doing a refinance, it's lower. So there's just a ton of things. If you have a disability from the service of 10% or greater, it's waived. It's exempt from there. So we can cover that individually, but if you're a veteran, this is absolutely the loan you want to do. Credit score is down to 500 with our lenders. Very lenient underwriting. So please, 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 if you're a veteran, this is the loan, the absolute best loan for you, hands down. Conventional loan. This is when you just see advertisements on TV. Typically, they're talking about a conventional loan. This is your standard. Most folks think of 20% down. I've got to have 20% down to buy a home. It's a conventional loan. This is Fannie Mae and Freddie Mac. Decent loan, but in some cases, the FHA loan is better for you than a conventional loan based on the amount of money you have to put down. We can do conventional loans with 3% down with no PMI for first-time home buyers and still get you a really good rate and some very low cost if you've got decent credit. Now, the conventional loans, they get very pricey if you've got, not excellent credit. So we take a look at kind of the range of your credit score. If you're below 680, we can still do a conventional loan, but it gets a little bit pricey. They put these pricing hits and adjustments on there, which really kind of turn the corner to make us think, hey, let's go FHA or let's do another program for you. So again, these are a ton of variables that we go over to figure out what the right avenue for you is. But if you got really good credit, decent down payment, very stable income, conventional loan's probably going to be the way that we go. Now, a USDA loan, which is the rural housing loan. This is a fantastic loan also. If you live pretty much outside of the city limits in any major city in a state, if you live in a city or in a state, my God, this is geared towards rural housing development. So, and they'll finance 100% of the purchase price as well, meaning zero down payment would be required. Zero down payment. They do have a funding fee and a very small amount of monthly PMI, far less than the FHA loan, far less than a conventional loan with PMI. But the caveat with the USDA is there are income household maximums that if you go over that, even $1, if you're $1 over what that income limit is, you're not getting the loan. And that's if you're married and your wife works or your husband works, and one of you is not on the loan, they count the household income. So both of you, whether you're both on the loan or not, if you're over that, it's done. If you own another property, there's nothing you can do. Even if you own a mobile home, if you live in a mobile home or a trailer, and unless you can show that you're upsizing for reasons of the family's growing and you're selling that property and getting rid of it, then the USDA is really geared towards lower to median income families that don't have any other option. If you've got a lot of money in the bank, retirement accounts, they're going to say, okay, you've got access to money for a down payment. This is not for you. So it's a little more restrictive. The property has to qualify. And I have literally seen one side of the street qualify, the other side not, because one side of the street's in the city limits, the other side of the street is outside of the city limits, maybe in the county or a different township or outside of that city limits where it's geared towards the county. But these are the four basic types of loans that we see. There are other loans that we do, but these are the main ones that we are going to be dealing with on a day-to-day basis. So what types of properties will these cover? So that we get these questions all the time. Can I do a condo? Can I do a high rise? Can I do a mobile home? So there are acceptable property types and there are unacceptable property types that might require, a niche bank or a niche lender to do. And I'll tell you right now, we don't do, if you got a log cabin, probably not, you're either going to need to have a big chunk of money down for a log cabin or find a bank that really does niches on, lakefront properties for log cabins. And the reasons are that they can't find comparable sales. If something were to go wrong and you default, they've got no way of really putting a value on there because it's such a one-off and unique property. But the main properties that we're going to be talking about are just a single-family residence, stick-built or brick home, just like what you'd see right here, just a regular old home, multifamily, townhome, or duplex, which is really nice because with multifamily also up to 4 units, up to 1 to 4 units, you can actually use the rental income. If the other side's rented out or if the other units are rented out, you can actually use that income to qualify for the loan, assuming your income is a little less than what it needs to be to qualify for that property. So if there's a history of rental income and tenants already in there that we can verify with leases, and a lot of the programs, we can use that rental income as well in order to get you in that property, which is really cool. Condominiums, typically 1 to 4 units high. We can go higher than that. Just again, there's some niche banks and niche lenders we use. Be prepared on condominiums. There are a few extra steps that are taking place or that have to take place with the HOA and the condo association. Sometimes they're easy to deal with. Sometimes they're not. Sometimes they charge a lot of money for these documents, which is a charge to you. Sometimes they don't. But just be prepared. If you're wanting to buy a condo, there are some extra steps that are involved, some extra money that's involved, and a lot of times a little extra time is involved in order in that as well. So if we can normally close in 30 days, you may be looking at 45 or 60 on a condo, depending on how well that HOA is going to play ball with us. If they don't play ball with us, it's going to take a little longer. If they're Johnny on the spot with getting us stuff back and forth, it's going to be pretty easy, and everybody's going to be, right up front with getting stuff done for you. So just be prepared for that. Also, double wides. Now we can do mobile homes. It's got to be a double wide. It's got to be built after 1976, and it has to be affixed to a permanent foundation. So, and that means not standing up on cinder blocks, not with just a little skirting around it on cinder blocks. It has to either be affixed to a slab or on top of a basement with all the footers and all the stuff that go in there that it's supposed to be done. Now, a double wide is also going to have a few extra steps involved in it as well. It's going to have an engineering certification done. It's going to have either, like a lot of mobile homes are on more rural areas. It's going to have a septic and sewer and water inspection as well. So just be prepared for more money out of pocket on top of the appraisal or any regular inspections you have, and the certifications that will go into that. So it's got to be, again, mobile homes it's got to be a double wide, got to be affixed to a permanent foundation, and it also has to be surrendered. The title has to be surrendered, and the property and the home has to be deeded with the land at the county assessor's office. So you've got to surrender the title, so it can't be registered with the DMV, and then it's got to be registered and surveyed as real property. So there's a few extra steps on that, but again, we do them all the time. There's the mobile homes today that are being built they're beautiful. They're absolutely wonderful, and you can typically get them for $40,000, $50,000, $60,000 less than a standard built home. Get you a nice piece of property and make the whole thing happen pretty quickly. So the biggest thing I run into with mobile homes is creating the value, because unless they're on My gosh, unless they've got some real improvements on the land, a lot of times they decrease in value as opposed to going up in value the way that a regular stick-built home is going to go. And that depends on the land itself and the area, but we can absolutely do them. Just know there's a few extra steps involved. And with all of these programs, there's every different loan program doesn't do every type. I mean, a lot of times the conventional loans won't touch mobile homes. Some VA lenders won't touch mobile homes. Some FHA ones will. Some USDA lenders will. It really depends on what your credit situation is, where the property is. There's a whole picture that goes into this, and each situation is just a little bit different. So if a mobile home is what you're thinking about, make sure you give us a call. Let's go through the checklist. Let's go over the details one by one and make sure that it's going to be the right fit for a loan program that we can get you squared away with. Okay, we've talked a little bit about the different loans, the property types. Let's go over some down payment assistance programs and what might be available for you. Well, here in Kentucky, again, like I said, we're in Louisville, Kentucky. We're licensed in Kentucky, Maryland, and Florida. But in Kentucky, we have what's called KHC, or Kentucky Housing Corporation. And I'm brain farting here a little bit, but each county in Kentucky has a different income limit, sort of like USDA. I think the maximum income limit anywhere in Kentucky is, I think, $125K. And that's for the difference in that is that's for the applicant on the loan, not the household. So if we've got two income earners on Kentucky Housing, only one's going to be on the loan. We only go by the one that's going to be on the loan. The other income earner in the house, we don't have to count that as part of the maximum, which gives us a little more leeway in doing things. But I think the maximum is 125, depending on the county you're in. This is only in Kentucky. There are programs in Maryland and Florida as well, and all across every other state and county and every different state in this nation. But we can. But what I've seen now, again, don't hold my feet to the fire on this, but what I've seen and what I've researched is in Kentucky, because I'm not in Florida or Maryland, I cannot get set up with those programs because I don't have a brick and mortar shop in those programs, whereas I do in the state of Kentucky. So each county in Kentucky is a little different for the Kentucky housing requirement. In all cases, they're going to lend up to the maximum loan amount is $314,827. They have a minimum credit score requirement of 620 for the FHA program, 660 for the conventional program. And the very brief summary is they'll give you up to $6,000 as down payment assistance as a second loan on the property on top of the first loan. This is repayable over 10 years at 5.5% interest, and it comes, if you take the whole 6K, comes out to about $63 and some change per month, again, on top of the first mortgage that they're going to originate for you. If you live in Christian County, Kentucky, or Hopkinsville, as of right now, as of the time of this recording, they have a $10,000 grant, non-repayable, what's called the HHF fund, the hardest hit fund, for counties that were underserved or underdeveloped, and the economic growth was pretty slow. So they've got $10,000 in Christian County or Hopkinsville, which is, I think, way in western Kentucky, kind of near Fort Campbell base anyway. So there's a lot of things you can take advantage of there. Also, in certain counties in Kentucky, we have what's called the underserved. It's an underserved grant, underserved areas. There's a $1,500 grant we can get on top of these, and again, the grant is never repayable. Let me back up just a minute on the Christian County. If you are in the Christian County area, the $10,000 is not repayable as long as you stay in the house for 5 years. If you sell or refinance within that 5 years, then you're going to pay off 20% a year for those 5 years if you sell or refinance within those 5 years. After 5 years, it's non-repayable whatsoever, and you never make a monthly payment on it. So again, all programs are going to have the credit income requirement or the credit requirement of 620 or better for the FHA or USDA, and then 660 for the conventional. For those of you outside of Kentucky, you're going to want to look at, there's a website down here you can take a look at, www.downpaymentresource.com. This will give you a ton of, this will give you information on how to search for programs available in your area. You'll punch in a few questions and it'll guide you right away to where you need to be. All right, I think I've touched on that. One second here. Let's get my computer up. Okay, let's dig into some closing costs. We've gone over down payment programs. We've gone over loan programs. Let's go over closing costs. Who pays them? What are they? When do they due? What's due? What can I expect? So a good rule of thumb, now I'll go over pretty much all of this here shortly individually, but a good rule of thumb on what to expect if you have to pay your own closing cost, a good rule of thumb is they're going to run about 1.5 to 2% of your total purchase price. And that, I might be off a few bucks up or down on that, but that's what I've learned over 14 years of doing this. So if you've got a $200,000 loan, expect around $3,500 to $4,000 in complete settlement charges. They may vary just a bit. Again, this is just a rule of thumb. Yours may be a little bit lower if your property taxes in that county are lower. If you've got really good credit, your home insurance comes in quite a bit lower. It could be a little higher as well. If you've got some dinged up credit a little bit, or you're in, let's say, in Lexington, where the property taxes are collected way differently than they are everywhere else in the state of Kentucky. Or if you're in Maryland, my gosh, they're crazy there, and they're collected up front. They may be a little higher, but 1.5 to 2% is a general rule of thumb that I tell everybody. And we buffer that a little bit to make it where I always try to over buffer in the beginning so it doesn't scare you at the end. But let's kind of go over what the closing costs are, what to expect, and all that good stuff. So there are really two sets of closing costs that make up your total settlement charges on any given loan. There's third-party hard loan costs, and there's prepaid and escrow setup costs. So let's go over the third-party hard loan costs on what to expect. There is, in all cases, there's going to be a title company, an attorney, or a closing or settlement agent involved, along with recording fees. They're going to have their own set of charges on here. These are third-party charges. You can shop these if you have a family attorney that's well-versed in real estate and can do this. If you've got a friend or family member that works in a title company, you can certainly shop these services on your own. Title insurance, which is required by the lender for when you buy a home. There's two types of title insurance. There's an owner's policy and a lender's policy. The owner's policy is an optional policy you can purchase. The lender's policy is required by the lender. And what this does is this protects them in case there's a claim against that property or something was recorded incorrectly previously, and there's now a claim against the property when it comes to ownership or a lien against the property or something that they can come back and take hold of that property above the mortgage company. So the lenders, you actually pay for, again, this is another situation where you pay an insurance policy to protect the lender in case something happens. And the owner's policy would protect you if there, in a perfect example, if there was let's say that there was a lien not released or a lien that wasn't recorded properly, that it's against the property, and no one found it when they were doing a title search. Well, now it's popped up 3 years later. Whose fault is that? Well, to the best of their ability, the title company used the information they had at hand. It just wasn't recorded properly, but now that's a legitimate lien. It comes against the property. Whether it's sold and the people that it was against have sold and gotten their money, now it's against the property. You're responsible for that. Now, I have been doing this a long time, and I have only seen an owner's policy come into effect one time in 14 years. And it was against my own house when we did a refinance. Something was absolutely recorded improperly prior to us owning the home. And had we not taken out an owner's policy, we would have owed a $40,000 debt from the previous owner on the way something was recorded. So thank God we had that, because it covered us. It took care of the litigation on it, got it all squared away. But I'm a firm believer in it. We have no dogs at any fight on any lender's policies, insurance policies, whatever. That's something you need to make a decision on your own. But I'm a firm believer in the protection on that, just because it saved me $40,000. Enough of that. Okay, so most lenders, you're going to see processing fees, underwriting fees, admin fees, broker fees, origination fees. These are things that we as a broker here, now you're going to see these pretty much everywhere you go. Because we have very little overhead at our company, we don't have these fees. We don't have a processing fee. We process our own loans. We don't have any underwriting fees. The lenders that we use underwrite the loans and don't charge us one, so we don't pass that on to you. We don't have any admin fees. Credit report fees, the only thing you're going to pay, that's going to vary from $20 to up to $100, depending on whether we've got to do a ton of updates or we've got to do some line corrections or whatever the case may be. This is really our only fee that you're going to reimburse us for, and that's at closing. You don't pay it up front. A survey fee, you're going to see that in Florida for sure. We don't require a survey here in Kentucky. I don't know if Maryland does or not, but every state's a little bit different on the survey fee. So if you have a survey, you're going to see that there. An appraisal fee, you're going to pay your appraisal fee 90% of the time. There are loan programs that do not require an appraisal if you're putting enough money down, and there are programs that will allow us to waive that appraisal fee for you to actually get you in the door to do the loan. But in all cases, if one's required, and let's just say it is for the sake of argument, that's going to run you about $500, and that's paid at the time of service. And what we do is once we order that, we either get a debit or credit card from you right up front, or we send you a link to pay that so you can pay that provider at the time of service. Because it's a third party, we order it through the bank. Let me touch on that too before we forget. If you've got Uncle Bob or Uncle Joe or Aunt Betty who's an appraiser, it's not going to matter. You cannot use them for your own loan. Appraisals are ordered through a third-party management company to keep a hands-off approach. We're not even allowed to talk to the appraiser because they think we're going to try to sway value. So it's a big no-no for. I mean, I can call them just to confirm an appointment. I can't even mention the address or value or anything like that. I mean, if it's just something cordial to set up logistics, then we're good. Other than that, we have no contact with the appraisers. We have contact with the appraisal management company, that third party, to do all of our buffers, all of our rebuttals. Anything we need to do goes through them to keep a hands-off approach from the appraiser. So points are when, where's my pointer here? Points are when you decide to buy a lower rate down. So let's say, for instance, the base rate for your credit profile and the loan program you're looking at is 4.5%. But you want to be at 4%. You just, Johnny down the street got 4%. You absolutely want 4%, or you want that payment $40 less than what it is. There's just no way around it. It just is what it is. So points, if the base rate is what it is, and it typically is what it is, if you want to get a lower rate, you can buy that rate down for a certain amount of money for a certain percentage of the loan. And 1 point equals 1% of the loan. So when you hear points, it just basically should be percentage points is what it is. They call them discount points. I don't know why you're not getting a discount with anything. I guess you're getting a discounted rate. But points are when you want to buy a rate down from one rate to a lower rate in order to get a lower payment. Okay, so prepaid and escrow setup costs. So these are going to be like the third-party hard cost on a loan that there's no way around. You can't do anything with. Actually, none of these you can do anything with, but it just depends on the way they're set up. These are called third-party hard charges, and then these are prepaids over here and your escrow setup. So the escrow setup consists of 1 full year of your homeowner's insurance, and you're going to select your home insurance carrier. All of you now have car insurance, so call your car insurance carrier and say, listen, I'm buying a home. What's it going to be if I bundle here? I'm buying a house for X amount of dollars. We're going to be escrowing. What's this going to cost me? Now, do not just take that at face value. Call 2 other companies as well and tell them you want to bundle the same thing. You'd be surprised at the difference in premiums from your insurance carrier to 2 or 3 insurance carriers around you. You want to make sure they're reputable, because if you call them, you want to make sure that also your premium or your claim is taken care of. So if you're very comfortable with your carrier now, call and tell them you're buying a home, get that bundled together. But in any instance, it's going to be the first full year of that premium is paid up front at closing. And then what we also do is we collect a property tax and home insurance buffer which is typically 3 months of those amounts to buffer that escrow account. And that's on top of the first year of homeowners insurance premium you're going to be paying anyway. So you pay the first full year, then you pay a 3-month buffer for property taxes and home insurance, because once the first full year is paid, that's paid till next year, and then we collect that every single month so I have enough money to pay it again next year when it's due. And that buffer is in case your price goes up for your property taxes or your home insurance. If you have a claim in that year, or if your property tax gets reassessed at a higher value, they need to have enough money in there to pay those and not make your payment go up. So that's going to be real important to understand. There is going to be a buffer set up in there as well. Daily prepaid interest. Let me explain what this is, because people freak out on this all the time. Well, what do you mean I'm paying interest? I don't even own the house yet. Well, if you close on the 15th of the month, let's say you close on May 15th, you're not going to have a payment due until July. So you don't have a June payment, it'll be due in July. So when you make your payment on the 1st of the month, you're not paying from the 1st to the 30th of that upcoming month. You're paying from the 1st to the 30th of interest in that month previous to it. So your mortgage payment is always paid in the arrears. So if we close on the 15th, that means there's 15 days left in that month. We've got to collect 15 days of prepaid interest, because congratulations, the day that you own your home, woo, I'm a homeowner, you start paying interest from that very first day. So they collect that interest in advance at closing. That way it'll push your payment back a full month and a half at that point. So you're not going to have a June payment. It'll be due July 1st. And that July payment is going to consist of all the interest that was due from June 1st to June 30th. We'll touch more on that individually to make sure you understand. Some people just can't wrap their head around that. It took me a while to get that one as well. But bottom line is, when you see prepaid interest, that's that's just the daily interest that's going to be collected to make your loan current before your very first payment. Okay, so a home inspection fee, you're going to want to get a home inspection. One's not required by us, Certain lenders do require them. Certain states require them. It's not required, but my gosh, you're going to want to spend $300-400 on this. They're going to go through that house with a fine-tooth comb. Unless you are a builder that's hands-on with everything and knows inside and out the workings of a home, you're going to want to get a home inspection. Again, they're not required, but for your own sake, even if it's a brand new home, I've seen so many problems with new builds that the home inspectors found that needed to be corrected beforehand. A lot of builders, they're not that reputable. Some of them, there's great ones and there's bad ones, like anything. So there's a lot of them will take shortcuts and do things that shouldn't be done. So you want to make sure that someone is on your side looking out for you. So and then next we've got pest control and termite inspections. This is typically, now the builders, if it's a new build, they're supposed to do this as well. They'll do it from the ground up. But if I'm buying a home, I want to know if that thing's needs to be treated for termites. If there's wood destroying insects that are going to tear up my rafters, tear up my beams, I want to know all that as well too. So a VA loan will require those. Other loans, they don't require them. But again, for $50, I'd have somebody go out there just to see what's going on in order to make sure that you're not walking into some huge infestation, which is going to cost you $5,000 in a big circus tent the first week here in your house. So again, these are the entire. This is what makes up your loan, your closing costs. Each one of these has their own line item on what's called the closing disclosure. Your fee sheet used to be called the good faith estimate, but these are all going to be broken down for you, and they make up what's called your entire settlement charges. And again, a good rule of thumb is about 1.5% to 2% of the price of your home is going to be what makes these up. Again, that's just a rule of thumb. Some are going to be less, some are going to be a little more depending on your county, your state, your property taxes, the home insurance you select. But that's a good rule of thumb. And whether you select a realtor or not, they'll typically have good contacts for home inspectors, pest control folks, and some home insurance people like we do as well that might help you out quite a bit. So that takes me to our next part of this is, do you need a realtor? I mean, is it something you should put on your side? Well, I'll go over some pros and cons here with you, but if it were me as a buyer, I would absolutely, without a doubt, 100% have a realtor on my side. Now, you're not required to have one, but I cannot stress enough how much you absolutely need one on your side. So yes, you need a realtor if you want to protect your interest in the transaction. And let me tell you why. A realtor, you're not going to pay the realtor. As a buyer, the selling side pays the realtor. The person that lists their home, they built in that 5-6% or whatever they built in to pay both sides of the closing table for the realtor's commission. So, you always want to make sure someone's protecting you, because if you walk into a property, you might think, I've got more buying power because there's not a realtor. I can negotiate this better. Well, the realtor on the other side of that says, oh my God, I've got a buyer with no realtor. I'm going to get a double dip. I'm going to keep as much money as possible. Now, who do they represent? They could represent you both, but they've got more of a fiduciary responsibility to that seller than they do to you, because they've listed that property with them. So they're going to hold on to as much money as possible as they can. I'm not saying they won't give up some money on that other side, but it's going to be more of a double dip for them. And they're going to be looking out for their interest and their seller's interest more than they're going to be looking out for you. So you just want to make sure that you're squared away. And they're also going to want to make sure you're pre-qualified. They're going to make sure that you're looking at the right type of house, because we work very closely with realtors on a daily basis. We're not going to tell them your personal information, anything that might, invade your privacy, but they're going to need to know, are you qualified? Can we buy this amount of house? What are we looking at here? And we're going to communicate that with them to make sure that they are showing you exactly, where you need to be looking. You may think you want a $400,000 house, but can afford only $250,000. Well, they're going to make sure you're just looking at $250,000 and get the best available selection based on that $250,000, what you're qualified for. So they're going to help you with your offer. They're going to help you with the closing cost as far as asking the seller to pay them. So let's go on to who pays for closing costs. Let me back this up just a minute here. Okay, so who pays the closing costs? Well, they're going to get paid one of three ways. Either you're going to pay them, the seller's going to pay them, or the lender's going to pay them. So when you hear these no closing cost loans, they're not no closing costs. They're no closing costs to you, because you're going to take a way higher than normal rate. So if the base rate's 4.5%, you might be taking 5.5 or 6 to get that no closing cost, because they're going to make up money up every single month when you're paying that monthly interest for them to give you a few $1,000s in closing costs. Or we're going to ask the seller to pay for them, which is always what we do first to to see if the seller's going to pay them. And 9 out of 10 times, the seller's going to pay those for you. If the seller's not going to pay them, then what I can do for you is give lender credits, again, but a slightly higher rate. We'll take a look at what you have available to pay, what we need to come up with between us. And then let's say, again, 4.5%, we might go to 4.75 or 4.5 to get you some lender credit in order to offset some of those closing costs. So there's no such thing as a no closing cost loan. You're paying it one way or another, or the seller's paying it. You're either paying it with a higher rate, a much higher rate, or the seller, or a combination of the two, or the seller's paying with what's called seller concessions. And that's the very first thing we always do. So when I'm working with the realtor, I always want to stress. All right, I had a little technical difficulty there. I'm not sure exactly where I left off. It took me a minute to get back on, but I think we were talking about the closing costs, who pays what, and do you need a realtor? I know we'd gone back just a little bit. So I think we left off to where, we're always going to ask the seller to pay for the closing costs, which is what the realtor is going to offer or put in your initial offer for, putting forth a contract. So it's imperative that we work together with the realtor to let them know exactly what those closing costs are going to be. And we overbuffer those quite a bit as well. So they're going to be the one who structures that for you. They're going to help you put that offer together for those closing costs to be paid by the seller. And again, 9 out of 10 times that seller's going to do it. I mean, typically they do. A lot of times, if they won't do it, sometimes we'll bump the contract up a little bit in order to show them paying the closing costs, and they still net out the same amount of money. So you want someone that's very well versed in putting these offers together on your side, and to also to help you, educate you on what to look for in the home with the home inspectors. I mean, to help you understand your inspection rights, your financing contingencies, and not to mention they're going to help you gain the access to all the properties you want, do all the legwork for you, all the searching for you. Even if you find a property you like on your own, whether it's Zillow, Trulia, Realtor.com, whatever, they're going to have access to get to those lock boxes, to get to those realtors, to get those appointments set for you. So they bring a ton of value to the table for you without you actually writing them a check. So to me, they're absolutely invaluable. You absolutely should have a realtor on your side because you're not paying them directly. They're, again, paid by the seller. So that being said, I don't want to spend a ton of time on that, but that's a decision for you to make. If you feel you're a master negotiator and can do it without one, then by all means, that's up to you. But I would certainly have one on my side walking into any negotiation to making sure that my assets are covered as well. So let's talk about some of the do's and don'ts, which is really, really, really super important on what to do before, during, and after, and what to definitely not do during the process. So that's just just a nice little slide there. I don't really have anything to say on that, but I want to go through what to do before, during, and after the process here. So what you're going to look at, first of all, is kind of going back to the pre-qualification process. You're going to determine the down payment available that you have based on your available funds. That's just going to tell us what loan program we have. That's going to let us get our funds together, our bank statements, our asset statements, whatever we need in order to really figure out where to be before you start the process with a realtor. We're going to define your monthly payment that fits into your budget with your debt to income calculations. These are all things that are done prior to you going out shopping for a home. We're going to gather up all these documents so that they're in one file at one time, stacked nice and neat for the underwriter. It's called stacking your file. We're going to make sure we have everything up front. And typically what I'll do with my borrowers is I'll front load them with information that's needed. I'd rather get it all up front than piecemeal it together, bit by bit during the process. Not only will it save you frustration, save us frustration, it's going to save time as well, because if we're going back every 2 days asking for something, you're going to be like, gee, man, why didn't you just ask me for this up front? I already had it. So we typically try to get everything squared away up front without, going back for more. Now, let me qualify that. No matter how clean of a file we put together for an underwriter, they're going to want more stuff. They're going to want some T's crossed, some I's dotted, maybe some clarification on some documentation for bank statements or verifications of employment. They always do. Don't get frustrated. Sometimes you'll give us things twice, and it's just an update of what you gave us before. It's because we're being asked for it. We don't just do this. Hell, I would do this with no documentation if I could on everyone. In some cases, we can do that where it's just internal pulls through electronic services, and you've got to provide very little documentation. But for the most part, we collect everything up front. You're going to get your pre-approval letter once we put your debt-to-income ratios in play, once we see what your credit scores are, and put that monthly budget together for you, what your total housing payment's going to be. Number 5 here, consult with the real estate agent. We already talked about that. Find one if you want. If you don't, that's okay too. Then from there, once we kind of get all the things together we've been talking about up to now, now's the fun part. You get to go shop for your home. You're going to want to go out and find what you want, find that home, find your dream home, find your second home, your very first home, whatever the case may be. This is where the rubber meets the road at this point, to where everything you've done is built up to this point. So shopping for the home shouldn't be that stressful. And be prepared also in this home buying environment. If you find what you like, don't be afraid to pull the trigger, because in 2 hours that home might not be there. I've seen people go back and go to lunch and come back and the home's not there. They've got 3 offers on the table and they're all over the place and the home's gone. You don't have a chance of getting there. So if you find what you like, make your checklist of what you can live with, what you can live without. And then if you find something that meets more of those than not, be ready to pull that trigger, because again, in today's environment, there are way more buyers than there are homes to buy, unless you're just wanting to build something, which you're probably 6 to 9 months out at that point anyway. Then what you're going to do is make your offer, and then that's where your realtor comes into play, or whether you're really savvy at doing this. I mean, depending on what you're going to do, how you're going to make your offer, structure the closing cost in there, or whatever the case may be. That's when you make the offer. Again, we talked about some of this before. During the process, your home inspection, not required. Recommended, not required. The home appraisal, we talked about that. We order that directly through the third-party management company. You have nothing to do with that. And then a couple of days before closing, once everything comes into place, we've underwritten the loan, you've gotten your home inspection, the financing's all ready to roll, you're going to do a final walkthrough of that property. This is very important, because there could be things you see in that walkthrough when everything's moved around that you didn't see before. Moving furniture, there could be holes in floors. There could be carpet that's ripped up. There could be burn marks, holes in walls that were behind pictures. This is where a walkthrough is this is why a walkthrough is so important. You want to make sure that you know what you're walking into. And it's at this point, if things are not what they were, you put together a quick punch list and hit list and have them correct the stuff right away, or you delay that closing, because you definitely want to make sure that you're getting what you thought you were getting 30 days prior when you put that offer in. And then you do your final closing. You sign the papers. And that's really what it's all about. So that's what to do before and during the process. Let me give you some don'ts. That's what you do during the process. Let me give you some don'ts. And I'm almost even embarrassed to have to say some of this stuff, but if this wouldn't be written down if these things didn't happen. Okay, do not make any major purchases like furniture, appliances, jewelry, cars, etc. Number one, you don't have a house yet to put your furniture. Number two, you don't even want to think about the word credit during your process, during the loan process. If you apply for any credit, they monitor you during the entire process, and it's going to throw up a red flag where we've got to now verify what that inquiry was for and what it's going to, and whether it resulted in new debt or not. I've had a guy, no BS whatsoever, went out and bought, 2 days before closing, went out and bought a $700 a month car, or $700 car with a $700 a month payment, and wondered why we couldn't close on him, because it took him from like 48% debt to income ratio up to 60% debt to income ratio. And I'm like, well, dude, you better be able to sleep in that car, because you're not getting a home loan now. So don't even think about the word credit during this process, and stay away from applying for anything at all. And again, furniture and movers are not your concern until you have a firm closing date in place. So don't think about furniture. You can think about it, but don't go buy it. Don't go spend money, because you don't have anywhere to put it yet. Don't change or quit your job. You'd think we wouldn't have to tell people this, but if you lose your job, you change your job, that changes the whole structure of the loan. They're going to call the day before we close to verify you still have your same position. If you don't, then guess what? You're not getting the loan. So that should go without saying. Consult with us before withdrawing, depositing, or moving large amounts of money in or out of your bank. This gets very tedious. Don't transfer money back and forth from one account to another. Don't make cash deposits unless you have a receipt for something you sold in cash. Every dollar, every penny on every loan has to be verified and sourced, especially when it's moving around from one account to another. So just don't do it. Just absolutely don't do it. If it's not a direct deposit or ACH deposit we can verify that's on that bank line item, you're going to be doing a ton of legwork to verify deposits, and it's going to be very frustrating for you. And it's going to be frustrating for me because I've got to tell you to do it. So just do not do it. There's no reason to switch money around. Keep your money in your account. If you need something, take some cash out, put it in your pocket, whatever. Do not move money around from one bank account to the other. Also, avoid using cash for your good faith deposit, the money you put on your contract. Now, if you don't have if you don't have a checking account, or if you have an account that doesn't have checks, you may need to get a cashier's check or a money order. If your bank is not on site, like USAA or Navy Federal or something like that, there's some things we can do, but it's got to be paper trailed. Everything has to be paper trailed, especially if you use a money order. They want to see a check, or they want to see an ACH or cashier's check. But if you have to use a money order, there's a process. We'd go with that as well. Paper trail the withdrawal with the deposit slip, buying the money order, getting a copy of the money order written out to the company, and then taking a picture of your bank account, or taking a history of your bank account showing where that money was actually taken out. So there's some extra steps involved, but avoid using cash if at all possible it's not even really, you can't verify it. So just do not use cash for the good faith deposit. And again, I know this one down here, don't have your credit report pulled too many times. Just don't have it pulled at all. I mean, when you're shopping for a mortgage, if it's another lender, that's fine. That's not going to hurt your score. You're allowed and allotted so many credit pulls when you're shopping for a mortgage. They understand you're probably not going to go with the first person you talk to, unless you're just really comfortable and everything makes sense to you. But you don't want to be shopping for furniture. You don't want to be shopping for cars, credit cards, personal loans, anything like that's going to throw up huge red flags. It's going to ding your score, because again, they're going to monitor your score from the day we put that application in. If anything hits to your social security number, they have red flags that pop up, and they're going to want to know right away what's going on here. We've got new debt or new inquiry activity. We've got to figure out what's going on. So just don't even think about credit for the next 30, 45 days on while you're doing this process. And that brings us to my next slide here, is how long is the whole process going to take? Well, each loan is a little bit different in and of itself, but what you can expect typically is about 30 days. I mean, every loan program has a little bit of a different turnaround time, but for the most part, a good clean loan file, assuming there are no property inspections issues or appraisal issues, you're looking at about 30 days, 25 to 30 days on FHA, 25 to 30 days on VA. Conventional loan, 25 to 30 days. USDA is a little bit different because it goes through a two-step underwriting process. Once we get rid of the file, it goes to the state field office for USDA. Then depending on how many files are in their queue, that can be there for 2 hours or 2 weeks. I mean, we just never know, because typically every state has 2 or 3 offices, field offices, and it has to go get their stamp of approval no matter what. So again, I don't want to spend a ton of time on this, but assuming there are no appraisal or inspection issues that need to be corrected, 30 to 45 days is typical. If you're Johnny on the spot and get everything to us when we ask for it, I'm knocking loans out in 2.5, 3 weeks. But not everybody's like that. I mean, it really just depends on you guys. I mean, if you're just the norm, you're looking at 30 days. If you want to get this thing done, I can move at the speed of light, or I can move as slow as a tortoise, depending on where you are mentally in the process of wanting to get stuff taken care of. So after 30, 45 days, we close your loan, and it's time to get you there, man. It's time to get you to the closing table, and congratulations are in order at that point. It's now time to sign the closing documents, and that's our ultimate goal, is sitting down and getting things squared away, grabbing your keys, then moving in. You're about to actually find out who your friends are when it comes time to move. Tell them you're moving to a new home and see how many scatter. Typically a bucket of chicken and a case of beer used to be the case, but you'll find out really quickly who your friends are. So what I want to do here is just create a realistic expectation for you on what to expect during closing, during the process at the attorney's office or the title company. So I will always have my documents out 2 or 3 days in advance for you guys to review, whether it's the closing disclosure, the closing package, whatever, every line by line item. You're going to know what that is. Now, there's a ton of stuff you're going to sign. 99% of it is really just saying if you don't pay on the loan, they're going to come take your house. There are 3 or 4 sheets which cover the line by line breakdowns, which will all match up as far as the money you're bringing to closing for your closing and settlement funds, if any, and what your payment is, what your interest rate is, whether it's fixed, whether it's adjustable, how long you're going to be paying on it, et cetera, et cetera, et cetera. So you're going to want to read through that a couple of days prior, because the time to do that is not at the closing table. I can tell you this, the attorneys are going to get frustrated, and they're going to postpone you if you've got to go through line by line while you're there and figure everything out. So anyone that's worth their weight in this business is going to have your documents out a couple of days early for you to review that, have time for questions to be answered, and go over everything you need to do. Be respectful of others in that closing table, in that closing room too. It's going to be you and your significant other, if there's someone else on the loan, your realtor, their realtor, 2 other people, an attorney, and typically a mortgage broker. If at all possible, leave your kids at home. I mean, everybody loves their kids, but nobody wants a 2-year-old and 3-year-old crying and screaming around at the closing table. If you've got absolutely no other option, then it is what it is. But this is a time where you really need to concentrate on getting this stuff taken care of. And there's nothing more annoying than, worrying about crayons here, chocolate milk over here, a juice box, juicy juice, whatever the case may be. You're going to be there for about 45 minutes, and it can drag on. I've seen them drag for a couple hours when there's just so much activity going on in the room, and it gets a little bit frustrated. So do everybody a favor, go through your docs early, and leave your kids at home if you absolutely can. I mean, or find a sitter with them, whatever the case may be. But it's going to make it go smooth for everyone. But again, if you have to bring your kids, I'm not saying don't. It's just going to be a lot easier for you if your concentration can be fully, put into what you're doing at that point without worrying about outside obstacles. So I think we've covered everything. I just want to do a recap here to make sure that I've gone over what I told you I was going to cover. And so I said what we'll do is from A to Z, we're going to cover the process. So let's go over this. We covered the pre-qualification. We covered credit requirements. We went over income requirements, DTI. We went over the different loan programs through FHA, VA, USDA, conventional, which are the base 4. We went over down payment requirements for each of those on the loan, down payment assistance programs, which in Kentucky, it's the Kentucky Housing or the Hardest Hit Fund or that $1,500 grant. We went over the acceptable property types, regular stick-built home, mobile home, condos, townhomes, and multi-units. We broke down 3 different payments to let you know what's involved with those. We went over the closing costs in detail, a good rule of thumb on how much to expect and who pays them. You know my feelings on selecting a realtor, so we've been over that. We went over the do's and don'ts during the process, how long it's going to take, and then closing the final go. So after closing, now what? You're done. You own a home. Welcome to homeownership, Mr. Jones. You no longer get to call your landlord if the water breaks, if the water pipes break, or the AC goes out. This is what you need to do on your own. So what I would always tell folks is, closing is pretty much the only time you get to do this. Otherwise, there's some waiting periods. It's get a home warranty. It's going to run $400 or $500. A lot of times the seller's going to pay for it. This will cover your major appliances, your HVAC, your hot water heater, your furnaces, all that stuff like that. Home warranty is absolutely is very important to do. So I highly recommend that. Again, no dog in the fight with anything. Don't own a home warranty company, but that's something you definitely want to make sure that you get taken care of. So I feel like we've covered everything I promised you we were going to cover. The last thing I've got to do before I do some question and answer, I've got some frequently asked questions that a lot of you probably are going to have, and I'll just go right through them. Before I do that, for those of you that are planning on buying a home in Kentucky, Florida, and Maryland, we have done something very special for you guys that decide to pre-qualify with us and take that next step. If you don't want to, that's okay. It doesn't hurt our feelings. This webinar, hopefully it was very informative to you. You still get the e-booklet. You still get all the information you had right here. You have your notes. This will work. This is the same process no matter where you live in the country. But for those of you that want to take the next step, what is your next step? It's really up to you at that point. So you can either take the information, store it away until you're ready to begin the process, just kind of let it float on the back burner, get to do some more research. You can take this information, seek out someone else in the mortgage business to help you and navigate the entire process. That doesn't hurt our feelings either. We'd love to earn your business and have the opportunity to compete for it. But if you feel that you just wanted this information and to go with someone else, that's okay too. We wish you the very best. And we really hope that this is on your part, that you give us a call, you shoot us an email, send us a text, and set a time for us to actually evaluate your situation, let you know exactly where you stand, what you qualify to purchase, and what your next moves are. You can reach us this is actually my email address, scott@firstlookmortgage.net, or lynn@firstlookmortgage.net. This is my phone number directly. Please feel free to call or text me. I'm very responsive. I'll get back with you as soon as as soon as my hands are free. And before I get to the special offer for you guys, I want to thank you all for taking this time. I know it's been about an hour and a half, and I truly hope it was informative and helpful. And I do hope to help as many of you as possible obtain the privilege of homeownership and put you on that path, man. It's life-changing, it's scary, but it's very rewarding. So for those of you that take off here, I want to wish you the best. For those of you that are in Kentucky, Maryland, and Florida, here's what I've got to offer for you guys that actually decide to come on board and do a pre-qualification and hopefully go down that path of letting us help you obtain a mortgage to buy a home. So on top of number one, us being one of the highest rated companies in the states that we're currently licensed, on top of our unmatched service rates, lowest cost around, we're going to give each of you that go through this process with us a few different things. Number one, we're going to give you a full Tri-Merge credit report that shows you exactly where you stand and where you need to be, that's on the lending model. This isn't like your Credit Karma report. This isn't like your Equifax report. This isn't like one of the commercial reports. This is the scored lending model that tells you exactly what every lender in the country would see for the next 120 days if you're trying to buy a house. This is about this is about $30 for me to even pull. I'm going to give that to you complimentary. That may not sound like a lot in and of itself, but and it'll also give you a what-if simulator to tell you where your scores could be if you did this, if you did that, if you just adjusted a few things here or there. That's number one. The free e-booklet digital download, that was on here before I gave it to everybody, so everybody gets that anyway. You're also going to get access to this webinar replay whenever you choose, which means you get a little foggy on some of the information. You're going to have a link to come on here and not re-register, just go see this again. What we're also going to do for everybody is we're going to give you up to $525 of an appraisal fee reimbursement on certain programs that we have. Now, every program doesn't allow us to do this, but for those of you that qualify for certain conventional loan programs, we're going to pay your appraisal fee up to $525. That's money you don't have to. That's money you're going to get right back reimbursed to you at closing, real cash, real money. And every person, every one of you that does a pre-qualification with us and goes through the process and closes a loan with us, every application, every borrower, or just every application, if there's two borrowers on one loan, is this the application that does a pre-qualification with us, we're going to give you $1,000 cash towards your overall closing cost picture, and that's everybody, no exceptions. That's on top of also those of you that are going to qualify for the $525 appraisal fee reimbursement. So some of you are going to get just $1,000. Some of you are going to get $1,525. And again, the $525, there are certain programs that allow us to do this. I'd give it to everybody if we could, but there are rules we have to play by as well. Some programs will allow us to do this, and some of us won't. So no matter what, you're getting $1,000 real cash money at closing, and a good majority of you guys are going to get $525 as well to offset that appraisal fee on top of everything else. So this is free money. This is free money towards all of your costs, towards your appraisal. It's our way of saying thank you for allowing us to earn your business. I mean, you've got a lot of options, and we definitely want to make this an absolute no-brainer for you. And what better way to do that than to bribe you with some money? And we hope it works. So we'll find out soon enough if it does. But again, I want to thank you for your time, and really, truly, Lynn Marie and myself cannot wait to speak to you guys one-on-one personally to get you guys down the road and get you in a home. So all that being said, I think, hold on. Yep. I'm going to go over some of just the basic. I've got maybe 8 or 9 questions here that come up every single time, and I want to address them. Okay, first is, I always get this, can I borrow money for my down payment? Yes and no. There are ways to do that where the money's sitting in your account, but you've got to do it well in advance, at least 60 days in advance of you applying for that loan, because the money has to be seasoned and sitting in that account for 60 days and not showing as a deposit. So, and you've got to qualify for the loan with that debt ratio in place as well. So that's one way you can do it, or you can have the money gifted to you from a very close friend or family member or employer. And there's a form we fill out for that gifting letter. It's just a couple of steps we do so they can actually give you that money as well. Like I said, if you actually do borrow the money, it's got to be sitting in your account for 60 days. And there's it's called seasoning requirements we have to get squared away from that as well. So, okay. When do I pay for the appraisal? The appraisal is always paid for at the time of service. So what we do is one of two things. If we're going to send you a link to pay that, where you can go on securely to your put your debit or credit card in, or you can give us your credit or debit card over the phone. We order it and pay for it at that time, and then we just get rid of that information, delete the file altogether. Okay. Can I take money from my IRA, 401k, retirement account for my down payment and closing costs? Absolutely, yes, you may. I've done this a long time, and I've never seen a program not allow that for the hardship withdrawal or for buying a home. Now, a lot of times you can take a loan and you're paying back your own money. You can take a loan out of your 401k or retirement account, and you just pay back weekly or bi-weekly or however you're paid at a certain interest rate that you're paying to yourself. So you're paying your own money back and paying yourself interest, which, there's nothing wrong with that at all. And most of them are going to have a provision where you can do that. There's some documentation we need to provide, real simple stuff that's already in your plan, the wording for withdrawals, the loan application or the withdrawal application you're going to take. And then once that's done, we get a copy of the check or the ACH withdrawal, watching it go into your bank account. And then that's the way we verify that. Okay. What about mobile homes and why are they different? We covered that a little bit, but what some of the things you're going to need to really know on a mobile home is it's got to be newer than 1976. It's got to be affixed to a permanent foundation and transferred to real property as opposed to registered with the DMV. So that's pretty simple to do. I mean, the engineering search probably going to run you $400 to get it transferred over. Then the seller's going to have to surrender the deed and get it transferred over to real property if they haven't already. I don't know what that's going to cost. Each county is going to be different, but it needs to be real property that's assessed by the property value, the PVA, and it has to be on a permanent foundation. And yes, we have those programs that will take care of that as well. Okay, I cannot read my own writing. Do multiple inquiries for a mortgage hurt your score? No. If you're allotted a certain amount of time, not 21, 30 days, something like that, you can have multiple inquiries. You're going to have multiple hits, but it's not going to ding your score it's only going to ding your score for the one hit because they understand you are going to be shopping for a mortgage and it's not going to affect you that way. So it's not going to drop your score. They don't, even if you had 10 credit pulls in a month for other things, you're talking a point of pull for multiple pulls on that, but it's not going to do that when you're shopping for a mortgage because they know that that's a mortgage company. And once you start one, if you got a couple at that point, you're only going to get dinged as if it's just one pull. Okay. I have debts on credit, others pay. How does that affect me? So I get that a lot. So let's say it's just the husband on the loan and the husband has co-signed for, let me back this up. Let's say there's a joint credit or a joint account showing on credit for a car payment for $300 per month. You're divorced, the ex-wife pays it, the ex-husband pays it. Two things we do there. We can eliminate that on credit if we can show the divorce decree said that property is supposed to be paid for by the other person. We eliminate that debt altogether. Or if it's something where it's amicable, let's say you co-sign for a son or you co-sign for a daughter or whatever the case may be, we show that account has been being paid out of that other person's bank account for the previous 12 months. Now it has to be 12 months that they're paying on this, and we get to wipe that away. So just you're co-signing on something, it's not going to hurt you. It's not going to count against you as far as a debt, as long as we can verify either through court documents that another party's obligated to pay that, or if we can show bank statements for the previous 12 months of them paying that on their own. Okay. When can I buy furniture and hire movers? Remember on the do's and don'ts? Don't. You can do that once we have a closing date in hand. But still, I don't want you buying furniture, applying for credit, do anything. You can buy something once we're closed and it's done because they're not going to monitor you at that point. But don't hire any movers. Don't. I get this all the time. Well, I've taken off Friday next week to move. What are we closing? If you don't hear from your mortgage advisor, mortgage loan officer, broker, bank, whatever, that you have a firm closing date, don't hire any movers. Don't take time off work on an expectation that it's not there. And if you've got a good loan officer or broker on your side, they're going to keep you informed every step of the way and tell you this up front. They're not going to give you some, and there's bad ones out there. And there's people that'll tell you, oh, we're closing Friday. Oh, we're good. They won't give you the whole picture of things. Communication is the key in all of this. So do not hire a mover until you have a firm closing date in mind, and don't buy anything for a house you do not own is the best way I can do that. Here we go. If I've used my VA Veterans Benefit funding, or if I've used my VA benefit and paid a funding fee, can I buy another home? Yes, there's a couple ways we can do it. Number one, if you're buying another home and selling your VA home, you're the one that currently has a VA loan, we just wipe it out. I mean, we'll get a copy of the settlement statement. It'll restore those benefits right away. But you can actually have two VA loans at the same time with what's called a bonus entitlement. It's different for every person depending on what they've used previously, the county loan limits of what you're buying, and there are some other rules that go into play. But yes, you can absolutely have multiple VA loans at the same time. And what is my funding fee, and how much will I pay for it? Okay, I said we wouldn't get much into this, but here's the deal on the funding fee. If you're a first-time VA user and you have to pay a funding fee, it's 2.15% of the purchase price of the home if you're putting nothing down. If you're putting money down, that goes down in increments, 5 to 10%, all the way down to 1.25% of the purchase price. If you've used your VA benefit before, and you do not have an exemption for a service-related disability, you're paying 3.3% of the purchase price. It gets pretty steep, but again, you're not going to have PMI on these loans. If you have a service-related disability of 10% or greater, you are not paying a funding fee at all. All right, so my mouth is parched. I'm done. I hope you guys have learned a ton. Please do not hesitate to give us a call, shoot an email, whatever you may need in order to take the next step in the process. And remember, we've got $1,000 of real money for every one of you who does a pre-qualification with us and follows through the loan process. And we've got up to $525 in appraisal fee reimbursement for all of you who qualify for certain conventional loan programs, which is what we're going to try to get you on in the first place in any case. But no matter what, thank you again for your time. Have a wonderful afternoon. Do not hesitate to call us, and I look forward to speaking to all of you in the very near future. Take care. Bye.